David Osfiled, and David joined Edentree as a fund manager on the Amateur International Fund in 2016. David began his career at Alliance Trust, and in 2002 covering global and pan-European equities. He's passionate about sustainable investing, having completed a bespoke course at the University of Cambridge. Interestingly enough, David's based in London. He's from the northeast of England, but you live in Dundee. Is that right? Yes, that's interesting. For those of you who don't know Dundee, Dundee is famous for the Dandy and Beano children's comic, which I believe is Boris Johnson's favourite reading material. But I'm curious about choosing to live in Dundee when I'm from Edinburgh, but I'll not go there. So, but that's your panel for today. Firstly, I would just sort of touch on Alex. If you could maybe just sort of talk a little bit about the culture within Sarasin, how you manage money, and what you view sort of sustainability as a group.
Thank you. Firstly, I'll just say I've got dual nationality, so I'm perfectly hedged for the cricket and rugby. Sarasin and Partners is a London-based asset manager. We manage about £14 billion, and 10 billion of that is within the global equity franchise. I work on the Responsible Fund, and that is a global equity product that is very highly integrated with ESG and sustainability. Sarasin is world-renowned for its ESG credentials, and every product that we offer has ESG embedded within the process. But the responsible funds that I manage with the rest of the team just have that higher level. So we look to exclude various sectors, mainly classed as sin sectors, so we wouldn't invest in alcohol, tobacco or arms or anything like that, gambling. We avoid all of those. And as I say, sustainability and ESG is embedded within the business. Many of you may have seen us in the press yesterday talking about divesting from Shell from various strategies due to a failure of engagement. They have, sort of decided not to run their business in line with the Paris Climate Accord, and for many of our clients that doesn't fly. So again, we engage with them. It hasn't worked, and we've decided to divest. And that's probably about it for Sarasin.
Joe, could you maybe do an introduction on Walls and Futures and your outlook on London property and property? Yeah,
absolutely. Well, Walls and Futures is an ethical housing REIT, and I guess our remit and our aim is to generate a long-term income stream for our investors, but we're doing this by addressing the UK's social housing needs. And particularly, we're very specific in the areas that we're targeting so that we actually maximise the level of social impact that we make as well. So much so, I think last year, 2018, we were named the Impact Company of the Year at the Small Cap Awards. So we're also members of the Social Stock Exchange. So creating an impact is something that's actually, if you like, our DNA. But acutely aware that we're very much about generating a sustainable return because that helps us create more of an impact. So it's do a good job for your clients by helping people, and you get to keep on doing it. As far as markets and London property, well, London property is in the residential sense of the word, is, I think, in flux right now. It's definitely softened, and the ongoing political and economic uncertainty is having an impact. It potentially creates opportunities. We ourselves aren't investing directly in London right now just because we're seeing greater opportunities throughout the rest of the country. And specifically how we work is need-led, working with local authority commissioners, identifying what is actually needed over the next 10, 20, 30 years. So kind of focusing on the infrastructure of what's actually needed rather than just investing property for the sake of it. But there are opportunities.
David?
Thanks for the intro. We got in Dundee. So Edentree are leaders in responsible and sustainable investment. In fact, they were probably the first or maybe just the second by a month into this market back in 1987 when it was really not getting the same level of attention as it is today. It's quite a contrarian move. I think at the time, Gordon Gekko and Wall Street were saying greed is good, and we were doing pretty much the opposite, saying greed is not great. We focus on this entirely in terms of our strategy, based out of London, with a range of products around multi-asset and also global equities. I look after the global equity capability in the retail, institutional, and charity market. Fundamentally, in terms of how we view the world, the start of the whole movement came from the negative screening, but I think that's largely become commoditized now, as we see the rollout across the world in terms of exclusive policies. We look for companies now who are creating solutions for some of the world's biggest problems. And I think it's well established that those companies who are providing those solutions will grow in excess of GDP. Because there's some big problems out there that are aligned to long-term investment. In fact, Ian talked about a number of those things. And I think it's quite reflective of those companies that are doing good. And we look at it from what they do and how they do it. Those companies doing good will perform better than those companies who are seeing barriers in terms of social media and populism going against them or increased regulation. So it's a long-term strategy, and it's very much aligned to the way we see the world moving.
Joe, what I was interested in was the social housing sector over the past 5 maybe years, particularly locally where I'm from. There was various issues with local authorities trying to set up funds. There was regulatory issues. There was all sorts of issues on advising retail investors to go into that as well. Has the regulation loosened in the sense, is it easier from a risk perspective? Or what type of client are you looking to, as an investor in the fund?
Well, I think previously local authorities have looked at investing in their own housing. I think the key challenges that we've seen is one of expertise, not knowing how to do it. Over the last 20 years, the level of investment and skill set within local authorities has diminished. If you go back 50 years ago, local authorities were the biggest house builders in the country. That's where, and they had big housing departments, surveyors. That's where housing was, and we've seen that go the other side. It's now the private housing market, but they're chasing but they're looking at returns and creating a lot of private housing. So for us, with Walls and Futures, we've always seen an opportunity to get people investing in residential property because we definitely feel it's a great asset class, but it has to be done properly. We've been fortunate through our journey to go from a private fund for high net worths, and now we are a publicly traded investment vehicle. We're quoted on the next growth market, and that enables private retail investors to invest in the asset class, and because of our being quoted, you can invest in Walls and Futures through an ISA, your SIP, or you can hold it through your Hargreaves Lansdowne stock account. So we feel we've created a platform now where people can get involved in investing in residential property, but we're now in a sector specifically with the UK social housing needs, which we believe just by focusing on 2 areas, it requires, because of the shortage, there's something in the region about 50,000 places in supported housing and extra care housing, and it's basically housing where people need help and support to live independently, which is an area which actually saves the public purse a lot of money because people are now moved out of institutional settings. But that requires something in the region about, we estimate about £7 billion a year. That's the capex that's required right now, ongoing. It doesn't stop. That's a shortfall. But what's interesting for private investors is that there's, on the other side of that 7 billion investment, there's something in the region of over 400 million in long-term sustainable income to come off the back of that. So where government appears not to want to invest, there is an opportunity for ethically minded and private investors to actually get involved. And from a strategy point of view, and there was a slide earlier on which was looking at the if I understand correctly, two different portfolios looking at the ethical side of things, that ethical investing doesn't cost you money. We are members of the MSCI UK Residential Property Index, and there's some pretty big fund managers involved in that, in our universe as it was. And for the last 2 years, we've outperformed the index. So having an ethical element to it actually doesn't stop you actually creating a return. It's good business is still good business. It just happens that we believe we found an angle, which means we're actually creating that positive impact and actually generating the return, which I think is important too.
Just from my own perspective, a couple of things, comments there. I don't tend to mention Hargreaves Lansdown, as an advisor. I just stay well clear of them. But from a private investor, do you see that space growing? Because it's something in the, I would say within retail investors, and probably a space that we haven't invested in. In the property REIT, it tends to have just been traditional commercial property funds, that are in asset allocation tools. And maybe that just needs to be expanded, and more awareness that, that asset class, particularly from an ethical perspective, is out there.
I think, yes, it is something that where investors are looking at growing and getting involved in. I think residential property is also a market space where people are starting to look at, because for many, many years, when we first started our first fund, the pushback was always that people already had their own home, so why invest in another residential property? But I think people have looked at it and changed, and now see that there is residential property is a great way. We're seeing in the UK now more and more private rental sector funds coming in and building large-scale rental projects. 100 units, 200 units, and I think M&G has a PRS fund, but your minimum ticket in is 3-4 million. So it's an institutional product only. So we are one of a few where retail investors can get involved. And I also think retail investors, I know I've changed my outlook a lot over the last few years. Maybe having children's had something to do with it. But you start thinking more about the world you're leaving behind and the impact. It's not about me anymore, it's about my kids. So is there something we can do? And if I can generate the same return, if there are two investment products that generate very similar returns, but one actually creates a positive impact on someone's life or for the environment or something else, but one is a positive impact, then I'll place my money there. And I think partly that the market is changing really rapidly. I was at a ESG breakfast a week or two ago, and on great panel, the London Stock Exchange, British Land, and S&P, and the feedback was that a lot of companies don't realise that they need to get at the ethical side of things right, the ESG side right, because a lot of big fund managers have already excluded them and they don't know it. A lot of the passive funds have already said, if you're not looking at these things, and very much you're saying, Shell, if you're not prepared to, we're not going to invest in you. So the income flow. So it's actually growing really quickly. So retail investors are driving it, but we're also seeing it from the top, really. So it's a big space.
I mean, it's interesting that I've had more inquiries in the last 6 months than I've had maybe in the previous 5 to 10 years from clients looking for ESG solutions. And actually, it wasn't to do with fund performance. It wasn't necessarily to do with anything they dread about financial returns. It was all to do with plastic and David Attenborough. That was actually the driver of why the inquiries came in. So I don't want to invest in something that is harming that. So, which maybe moves us nicely on to Alex and David. From maybe a theme perspective, what would you think are the sort of hot areas around sustainability at the moment?
There's a number. It's not just around climate change. I think it's much broader. You brought up plastic, and I was particularly surprised at just how quickly that kind of changed societal behaviors and how much it's become a social no-no now to be using single-use plastic. So we have been anticipating that and looking at investments such as Mohawk, which makes they invested back in 2007, 2008, right in the GFC, in a plant that now reclaims over 6 billion plastic bottles and makes them into carpet, which is a fantastic circular economy store. And if you get sick of those carpets, you can give them back to them and they'll recycle them again into more carpet. And they take over 40 million tons of spent rubber tires and make those into doormats, which is not as technologically challenged as making plastic into carpets. But it's a great example of how to use sustainability as a competitive advantage, and particularly seeing what's going on in taking plastic out of our oceans. I think the whole circular economy movement is really just at the very beginning. I'd encourage you to go and read, if you haven't already, the work that Ellen MacArthur has done in her foundation. That's quite leading. Obviously, she was a fantastic sailor. What she's doing now is really quite transformational in terms of that movement. And in terms of other sustainable solutions, we have the just transition as well, which is effectively, if you think back to the very first example of that, which was when Margaret Thatcher shut down coal mines and we ultimately left with communities that had no jobs. We can't do this climate change transition without keeping people employed. It's going to have such a profound impact on communities. So this transition to low carbon environment has to be just. So we have companies in the portfolio who have used and invested from an innovative perspective. Companies like Aptiv, that was a key part of General Motors, very heavily exposed to the internal combustion engine, who today are now clearly leading in electric vehicle and electric architecture in the future of transportation. So this is very much a broad space. And actually, when you look at the second derivatives, it's incredible looking at driverless cars, looking how we live from a sustainable city perspective. And we know that there's going to be roughly 75% of the population living on 3% of the world's land, creating major issues for waste, creating major issues for transportation. There are hundreds of opportunities for solutions companies to address these problems. So it's quite an exciting and consistently innovating area.
The transition space is something that I think is quite concerning, because that's globally, isn't it? It's not just with the UK. And do you think that all the countries are actually signing up to that? Or obviously, that's maybe a loaded question, David. But
yeah, I don't know where you're trying to get to there. I think there's a lot of mistruths being put out in the political. I mean, that's no surprise. Politicians are born that way, right? I think the US, in terms of the leadership, has been very disappointing. The idea that coal is employing as many jobs as Mr. Trump is suggesting is deeply misleading. In fact, the number of jobs they're creating in solar and renewable dwarfs that in the coal industry. So that needs to be dispelled immediately. I think emerging markets is really important. Emerging markets have a very important natural capital that needs to be protected. And the idea that ultimately in the UK we started the whole industrial revolution. Emerging markets should have the right to have a higher per capita GDP emissions target because they're in a different stage of development. So USA's argument regarding China, India, etc., just doesn't follow suit. We think there's a huge opportunity, particularly in emerging markets. You just have to look at the South China Morning Post, for example, and look at the air quality issues, or look at the challenges in India as well. For example, the air quality issues. These are huge opportunities for companies in that area just to leapfrog and provide those solutions immediately. And you'll see enormous amounts of growth in these areas because they're so innovative and because the problems are so acute that they can address them.
I guess excuse me. It's unsurprising that we see identical themes. The investment landscape is, it's global. We see the same thing in plastic. We don't invest in any business that have material exposure to plastics. We think that the policy response will come eventually, and it will be a cost to many of these companies. One area where we do have exposure is linked to the transition. One of the companies is called Nextera Energy, which is based in the US. They have been buying up and shutting down coal-powered fire stations for some time now. For example, if you shut one down, you can probably take out between 5 and 6 million tons of CO2 a year if you replace that with renewables, which is what they do. Notwithstanding the President's comments on coal, which you alluded to, coal is actually coming out of the US system quite quickly because the economics just don't stack up. So regardless of what he says, it's a capitalist country. And if the economics of a power source don't make sense, they're not going to keep putting money into it. So I think the latest stat is that they've shut down 289 coal-powered fire stations since 2010, and that has predominantly been replaced with combined cycle gas turbines and, to a very large degree, solar and wind. Wind is now considerably cheaper than nuclear, than coal, and gas, and is much more efficient. So we see that transition, and we're looking to be on the right side of that. We wouldn't invest in companies that don't have a committed plan to shut down and exit these bad polluting stations. Other companies, I think water is a big challenge. I think if you look at all of the data in India, especially, the availability of fresh water globally is declining. We're using up our aquifers faster than they can be refilled. So we look at companies like Xylem, Badger Meter, and Neptune, who are all looking at using technology to bring in water metering and to save the billions of gallons of water that are lost through the system every year. You'll see, if you live in London, you'll see how Thames Water have been digging up the roads for about the last 15 years, replacing all of the old networks. This is a global problem. In the US, they don't even know where their pipes are. So, 90% of the cost of fixing all of this is digging to find the pipes and to find the leaks. And, we're looking for companies that have the technology to help them find them, which means that they can then spend much more money actually fixing the problem and trying to save water.
One area of concern for me is obviously it's great that the sort of sustainable sector is growing, but a lot of the fund groups who maybe don't have a pedigree or a background in sustainable investing, or as you say, Joe, ethical investing with regards to property, are spending significant money and coming to the market with solutions and products that maybe are getting distributed through various sources that maybe would dwarf maybe the advisory network or what you guys have as well. And I think that's a concern combined with maybe opaque ratings as well. Do you see it as a challenge, or do you see it's all competition as good competition?
I think we all welcome more sustainability managers. I think that the more people that do it, the greater the voice and the greater the effort that we can put in, which means that we can get companies to change faster. I think that's the big key. There is a certain amount of greenwashing that goes on in the world. Our experience is that the sophisticated investor can see through that quite quickly. One of the, passive as an example, doing this passively is extremely difficult. As an active manager, we exclude vast swathes of the index because they just don't live up to that standard that we put, that we have. And if you're having a passive fund, you're investing in that. It's very, very difficult to do the screening and to have the, zero in on all of these ESG considerations when you're doing it passively. So, we would say that if you're looking at it seriously as an investor, that you need to pick an active manager who has a pedigree, EdenTree, Sarasin. We've been doing it for 20 years, EdenTree even longer. We have a team of 10 investment professionals whose sole job is to look at the ESG considerations. They're backed up by another 4 stewardship specialists. We're doing it day in, day out. We don't have any other considerations other than to embed ESG into our process.
I'd echo exactly what Alex has said. I think it's really encouraging to see other mainstream fund houses moving into this space, and I think actually with great assets comes great responsibility. We as gatekeepers of capital flows to society, we have a responsibility to drive behaviours, hold companies to account, and that talks exactly to what Alex was saying in terms of active stewardship and engagement. And you can do that if you own more of the company, obviously, but you can certainly engage and have a very strong conversation. And if you have that conversation in the right way, it can lead to a material re-rating and appreciation of the stock price. That really comes back to the how the company is run and the ESG framework. I think there's a lot of confusion, though, in the marketplace. I think that's stopping, in some ways, the development. There's so many terms. It's like ESG, SRI, CSR, active, engagement, impact, responsible, sustainable. It's not easy to understand that, and I think the best test I could say to you is if you're looking at investment management, ask him how he's integrating ESG as the stocks that have changed in that portfolio as a result of being aware of those ESG risks. And then just take a look at the companies underlying in the portfolio, and if they don't pass the smell test, then you have to question the quality of the process. So, that's ultimately what you're investing in, rather than the brand. You look at all the individual companies, and ultimately the strength of those, if they don't fit with your values, and that's certainly what conversations we have with particularly a number of the values and client-led propositions that we develop, that if they don't fit, then you shouldn't be investing in that.
Joe, is there other ethical property funds coming to the market? Are you feeling that you're trailblazers? Do you have responsibility in that space now?
Well, I think I don't see any of the ethical property funds on the horizon yet. There are social housing funds in the market space, but in principle, I think from a social housing point of view, they happen to be investing in social housing, and therefore it looks like it's ethical. I think social housing is a marketplace. Ethical is a way of doing business, and the difference with us is that. For example, from an investment profile, we've never acquired assets from aggregators. We have direct relationships with charities, local authorities, to understand what they need and put solutions that match their requirement. And we're acutely aware of putting together and building really good projects, because these are people's homes. And in principle, we're housing, or we're creating housing for vulnerable people. So from an ethical perspective, we look at the buildings that we put up. We're looking at the energy performance. We're looking at, is there anything that we can be doing to reduce the amount of energy they use? Because actually what you end up doing is by actually solving solutions. So, for example, if we're putting together a housing project for low paid, then if we can make it very use less energy, then what you're actually tackling at the same time is fuel poverty. So that's one thing. And so it's not just about we happen to be investing in a space. It's actually, we're actually in our DNA trying to make people's lives better. And by fixing those problems, you actually find you save someone money and make a return. I think we spoke earlier, and you mentioned a company that you guys had invested in. You probably want to talk more about it, but it was by fixing a problem to do with monitoring patients overnight. They didn't have to keep getting woken up. So what you end up doing is giving someone a good night's sleep and not disturbing a patient all night long. But what you also do is save money, and so you create a better outcome for an individual, but save money for the people that are looking after them. So that's fixing a problem. And creating a better outcome, but making money. So I think there's that's where I think real ethical and social investing is. And it's great to see that there's less, I guess the sin investments, I would call negative impact, as in we don't invest in that because it doesn't cause a problem. And we're seeing more now people saying, we want to invest in something because it fixes a problem. And that's really encouraging. Ian?
Since we've been talking about impact, climate resilience, and real estate, I just wanted to put forward a proposition that we've been thinking about. One of the things that people ask me, so Ian, where do you see the opportunities, right? I mean, you're always talking about opportunities. Is that I think one of the things about climate change is that a lot of the climate change discussion has really been about carbon. How do we take carbon? How do we minimize carbon? All right. I think that's only a portion of the problem, because what you see climate change really is about, and I have a point to this, it's really about the disruption of hydrological cycles as a result of heat because of carbon. So if you're looking at cities and more sustainable cities and how we build climate resilience, this is really on one level about taking carbon out of the atmosphere, and trees do that, there's a lot of other things that do that. The second thing is really about groundwater. The 10, 20 fastest growing demographic cities in the world, a lot of them are losing water and it's going in the wrong place. You know, you've record droughts. The reason is that a lot of water is going to the wrong place. The chemistry of it is that every 1 degree that the climate heats, 7% more precipitation ends off. And so what you see is extreme weather events because groundwater goes to the wrong place. So in line with this, I just wanted to propose that I think there's a real estate play in here. We're starting to think about ways to innovate financial innovation in land. And forestry is the lowest level of what in real estate you guys call the higher, better use curve. Between economically inactive and economically active, the first stage is growing some trees on it. And consequently, besides improving the temperature and the air quality, it also keeps the groundwater and builds the climate resilience. So I think there's a play thematically in all of these.
Yeah, and I think it's quite important. We were talking about negative screening and about more positive investment. Again, just from my experience, the majority now of retail clients will take it as a given that there's a negative. They're not. That's just mandatory. It's actually the positive investment element that's the reason for the meeting now. That's the investment strategy, not the negative side of things. Which then sort of leads me on a little bit of concern maybe about the rating system that we have in the UK at the moment with regards to awarding funds, various globes, earths, whatever you want to call them, which I think can be extraordinarily misleading, and how they're actually awarded, the reasons why they're awarded, and I think education is quite important there. I think maybe with the ratings agencies and actually the end investor. I don't know if you get any comments on that, Alex.
I think one of the issues with the ratings is it's predominantly done on performance. It's very, very difficult to actually assess and measure impact. We're trying to do it. Most people are trying to do it, but the data is very, very difficult to come by. One of the areas where the data is okay and improving is carbon, is your carbon emissions. The CDP data that you can get is probably the most accurate. So we would always aim to be a far lower carbon intensity than the index, for example. As you know, carbon is a cost. The price of carbon keeps going up. It was up nearly 6% yesterday. This cost is going to be borne by more and more companies. Slight digression, but measuring impact and awarding funds, stars and ratings, as I say, until it moves away from being performance-led, I think you're going to you're going to keep having this issue.
I'm telling you, your biggest fan. I would echo those. I think it's a function of maturity. We're a very early stage of this, and I think there's probably a degree of understanding both of the rating bodies and the index providers as well. I mean, it's kind of dominated now by MSCI and Sustainalytics in terms of the provision of underlying data from which we start to work. And actually, we feel that this coverage is actually quite low, and it's far better for us to use our 30 years experience to try and find those companies that are not part of that index before they get picked up and before they get lifted up into that kind of universe and appreciated for what they are. But again, it's just the acid test. It's common sense a lot of the time. If you're seeing something in that portfolio that you don't think should be there, it's got a 5-star rating, then it's an obvious challenge. You shouldn't expect companies. I think quite well put in a recent Vanguard. I shouldn't say that name in specifically to that index provider, but those climate change providers who have oil companies in their ETFs is not really doing what it says in the tin. And I think our team have written quite excessively regarding mis-selling. I find it quite remarkable and quite frustrating that in the UK you're held a greater account for whether you produce the right amount of yield to be part of the global equity income sector, yet you can get away with saying anything in the world with regard to your ethical and responsible and sustainable criteria in a name. So I'll put that down to the immaturity of the sector, but we're going to get better at this. The companies are going to get better at disclosing it, and I think the index providers have a duty to get better at this as well.
Last thing I'm going to ask the panel before we open up to the audience is ownership and your shareholding. Obviously, you were in the papers yesterday, as we've got one of the headlines there about Shell. Do you feel that the ESG houses work together, or do you feel that you're sort of lone wolves and trying to, whether it's executive pay, whether it's about corporate structure, do you think there is a support network there for you all?
We very much work with our counterparts. Numerous examples. One recently is a listed business called EssilorLuxottica. They've just come together. It's a French and an Italian marriage, which hasn't gone very well. But we have held roundtables with all of the other, with the vast majority of other asset managers who hold shares, and we've had an engagement with the company on behalf of several shareholders. The letters here that we've written to Shell are signed by our clients, so we involve our clients. But there is a sort of a camaraderie. We are stronger together, and more asset managers are holding companies to account. It's part of being an active owner. We are stewards of our clients' capital. We're not passive. We have this discussion with BlackRock quite a lot. I think by the virtue of their assets, they are the world's largest coal company, just because they own 2% of every business in the world. They don't do anything. And this is part of the problem. So we work with many of our counterparts to try and make things better.
I think it goes to the essence of active management. What are we here for? What are the capital markets here for? They're to lift up companies through investment so that they have a lower cost of capital, and to punish those companies who don't do very well with a higher cost of capital, and that's ultimately what capital markets were originally for. The idea of kind of impact and supporting that, particularly in the private space, and supporting companies who come into market, whether it's equities through IPOs or whether it's through fixed income with lending to that, is very well aligned. In addition, so I think that's where you can have the biggest impact in terms of your engagement. So we entirely agree with what Alex is saying in terms of active stewardship, responsible capital, and working with big organizations like Share Action, for example, groups like Sarasin, and we have a very active corporate governance movement in the UK that we're very proud of. And actually, I'd say Hold Up the UK is probably one of the world's leaders in terms of corporate governance. So in terms of the corporate governance code, you could do a lot worse there.
Right, thanks. Okay, can we open up then to the audience? Have we got any questions for the panel? Chap down here.
Hi, a comment. I was surprised to see eucalyptus on your slides, Ian. It's, kind of called ecological terrorist. We have the Indian experience where eucalyptus was responsible for depleting water tables. And you spoke about the water and importance of it and the challenge that we are facing with the fresh water. And then I saw eucalyptus along with the teak wood on your slide. And I don't know how you kind of justify this, because if we're talking about green, I do understand that company you're talking about is carbon negative, but carbon neutrality can certainly be improved even in a carbon negative company. One of the pollutants, major pollutants, is fertilizer industry, water, air, both. And chemical and fertilizer industry has a bad name for polluting the rivers. Forestry is closely associated with the chemical industry, fertilizer industry. How do you create that balance? What is the scope for improving carbon neutrality, even in a carbon negative company? And what are your thoughts on that?
Thank you very much for getting straight to the heart of the matter. It is true that eucalyptus has a bad name, and there's certain features, I'm not a forester by training, but some things I've had to learn. Eucalyptus is considered to be a very fast-growing, water-intensive, invasive species in very many ways. And I believe the problem, as you've seen in a lot of eucalyptus plantations, is that it tends to scorch the earth if it's a monoculture. Basically, because it grows so quickly, it sucks out the moisture, and it sucks out the nutrients of anything else that grows around it. Am I correct about that? A big part of what we are doing, we acknowledge this, right? And we only work with FSC certified, and Forestry Stewardship Council comes with a lot of restrictions at the biological level about what you can do and what you can't do. For example, they highly discourage the use of overuse of fertilizers, and they don't allow you to do clear cutting. They also discourage invasive, and monoculturing is exactly the kind of things we have to do. The last thing that I wanted to mention is that this is probably a point that will resound with people who are slightly younger. There's a saying in crowdfunding and dealing with retail that the crowd is the protection. This is an asset class which is hugely uninnovated because it is quite technical in nature. There's about 1,000 people around the world who can reconcile the economic, financial, and biological dimensions of forestry. And we believe that this is really, really part of the problem. That the man in the street who wants to be an active forestry investor does not have the intellectual tools or the knowledge of this highly specialized field to ask the kind of questions that you're talking about. So in democratizing and creating liquidity in this asset class, we hope that nature will be a little bit more protected if we can put the knowledge, this specialized knowledge, in the hands of the many rather than the few.
Okay. This gentleman there.
Good morning. Thank you very much for all your inputs. I have two questions, one to Ian and one to the panel. To Ian, what evidence do you have that Africa is a high-risk investment in green industry, while we all know that is green investment, and especially in climate change, is a long-term investment. And most Middle Eastern investors and Muslim funds don't like short-term investment. The only way forward, I think, is a good business plan and a brave issuer to green Sukuk. I'm just putting that to you, and give me your opinion. The second question to all the panels, if I may, what do you think Brexit will affect, everybody laughing, what do you think Brexit will affect the investment, real estate investment in UK first and in Europe second? Thank you.
Okay. Personally, I'm going to state my, I work out in Africa as well. I've traveled out. So my personal position on this is that the risk perceptions on Africa as a riskier investment is a little bit misplaced. That's my personal view. And the reason for it is that if you look at the fundamentals of it, right? I mean, the natural resources per capita, if you look at the just demographic and population growth in consumer markets, it is clear to me that it's one of the few continents that actually is a market for the next 20 to 30 years. So I think the risk perceptions at the aggregate market level, in my personal opinion, is a little bit misplaced. I don't know whether you would agree. So I concede the point. The part that why we state that African investments are seen as a little bit more, should I say, perceived as a bit more risky, is because of corporate governance issues, historically, and also land title deeds. That in a lot of African countries, you have tenuous claims on land that are largely subject to gyrations in political cycles. This is why I believe that in aggregate, investors tend to see it as a little bit more volatile and a little bit more risky.
Brexit and property. I think it's largely unknown, I think, is the key issue, is what will actually happen. Will it happen? Deal, no deal? I think just from the sector perspective that we're involved, is Brexit's definitely had an issue with a lot of care workers who work taking care of, working in care homes, nursing, etc., throughout the country, especially in the southwest, which actually voted over, quite for Brexit, but they're suddenly realising their care workers are now leaving. So I think there's some challenges there. But as far as, let's say, prime London property, I think a lot of people are sitting on their hands and they're waiting to see what happens. What's going to happen? Will there be? I think long-term London is still a great place to invest. I don't think there's any doubt about that. It's just at what point of the cycle are you going to be in? Central London property prices have invariably increased for the best part of a decade. And for the last 2 years, the brakes have definitely gone on, and we've seen prices go backwards. There is super prime, and even that's had its challenges. I think there's still lots trading. We're still seeing properties trading at sub $1 million. There's a good market for that. Under 600,000 Help to Buy has been invaluable for developers in London and around the country, to be frank. But it's again, people will still need to move. It still happens: births, deaths, marriages. The property market continues. So it's whether will you see lots of investors. I think possibly more so than Brexit has, from an investment point of view, has been the addition of the additional stamp duty. That's been probably more of a killer in the short term for London property, for example.
I would just say that we are a global equities house. We manage funds across the globe. REITs, Real Estate Investment Trust, is probably 2 to 3% of a global index, so it is a very, very small consideration for us. UK is going to be an even smaller part of that, so we have absolutely no exposure there. I think when you look at Europe, the key sort of trends in Europe at the moment are rent controls. If you see many of the German cities are trying to put rent caps in, that's probably a bigger consideration for most REIT investors. But for us, it's not really an issue.
The only thing I'd add to that is that I think largely for Brexit, from a financial perspective, the FX is the obvious cushion. So whatever happens with the initial move, whether it's a no deal or deal, we'll see a significant move in FX, and as a result, because it's particularly transactional in terms of real estate, I would expect that would probably be particularly attractive for overseas buyers. If, let's say, cable was sub 120 handle, which is starting to push, starting to price in a no deal Brexit. So from a long-term perspective, I think that's starting to become a significantly attractive entry point for what is still structurally in demand area. But I think Brexit as a whole has been horrendously handled. The fact that we've had politicians managing to procrastinate over 3 years on this whole factor, we're still not any further down the line, is an absolute joke. And if we continue this way, and with respect to things like climate change, in the way we've handled Brexit, we've got a far bigger problem than Brexit on our hands.
I'm going to take a moderator's pass on Brexit, so chap here.
Thank you for beautiful presentations. I think you're all investments, so I have 4 questions basically. Are you Sharia rated, or can you be? If not, can you be Sharia rated? Because it's all basically, I think you checked off all the boxes on being Sharia rated basically. What are your minimum investment and returns annually?
We haven't gone down the route of reviewing our Sharia compliance, but it is a marketplace that we would love to get involved in, especially because of the long-term view. Property is a long-term view in our business, is about investing in really good quality property, which is leased on, our typical lease is 20, 25 years. I forgot the second point there. Minimum investment, we're a publicly traded company, so you can buy one share. But we are looking for, as a REIT invariably, other property companies can buy property, redevelop them, and then leverage up. We're not in that space, so we consistently need new equity, so we'd always be happy to talk. What we're looking to generate is a total return of between 7 to 9%, of which 3 to 4 we believe will come through as a dividend. One of the differences that we feel we offer is that we also have a capital appreciation element to our business, which isn't usually seen, well, definitely not in comparative social housing funds, because they typically just buy yield. Because we develop and put the projects together internally as a business, we also have the ability to create a capital increase as well.
We haven't explored fully the Sharia compliance, but I think, as you said, there's such an overlap between the responsible and sustainable investment field that it makes a lot of sense. We are very much open to retail investors as well as I said, institutional and charity. You can do that through all the major platforms or retail networks as well. So, and in terms of predictions, in terms of returns, I think it's a very dangerous thing to do. But in global equity markets, we also do multi-asset, where particularly large institutions come to us and look for CPI plus 2s to CPI plus 4, and we use balanced mandates to deliver that. And that's it's a very kind of grown-up conversation with regard to what should be expected, because I think investors are getting a little bit carried away in terms of their expected returns, given that we've done about 20% in global markets since the start of the year.
And again, just echoing what David said, the makeup of our funds is very much geared towards excluding many of the sectors that we would need to exclude to be compliant, although we haven't had any checks done fully. We are as well available on all sort of retail networks, as well as for institutionals, charities, and private wealth. Returns, we would aim to outperform the benchmark, which is the MSCI All Countries World Index, by between